Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Friday, April 17th, 2026, and we're seeing some notable developments across markets as we close out the week. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant narrative today is really about retailers under serious pressure. We saw QVC file for Chapter 11 bankruptcy, looking to restructure $6.6 billion in debt, and there's a 127-year-old retailer confirming more cuts in 2026. This retail distress is painting a clear picture of consumer weakness that we can't ignore. At the same time, Goldman Sachs came out with a warning that caught my attention. They're saying the continued market recovery really hinges on getting relief from interest rates. That's significant because it confirms what we've been seeing in price action. This rally we've had over the past few weeks is fragile and dependent on the Fed's next moves. Meanwhile, we're seeing interesting developments in crypto adoption, with a 233-year-old Wall Street institution going all in on crypto, which shows institutional appetite is still there despite volatility.
That retail weakness is concerning, especially with two major names facing such serious challenges. How are you reading the market's interpretation of all this?
Markets are showing remarkable resilience despite these headwinds. The Nasdaq is on pace for a 5% weekly gain, which is substantial. And we're looking at the S&P 500 potentially closing its third consecutive week with 3% plus gains. What's interesting is the selectivity we're seeing. Technology and AI-related sectors are getting bid up on optimism, while traditional retail is getting hammered. Oil prices are falling after Trump reiterated that the Iran war should end pretty soon, and we saw Israel-Lebanon truce hopes lift sentiment. The market is essentially compartmentalizing, rewarding growth and innovation while punishing old economy models that can't adapt, for the indices specifically. The S&P 100 is showing strong momentum above key moving averages. The Nasdaq is leading with tech strength, and the Dow is lagging but still positive, held up mainly by financial and industrial names that aren't facing the same consumer headwinds as retail.
What does this mean for traders looking at opportunities in this environment?
Traders need to be tactical here. The opportunity is in staying with the momentum in technology, particularly AI-related names, but you've got to be ready for volatility. We're seeing Nvidia's rivals seeking at least $100 million in funding as the European AI chip market booms, which tells you competition is heating up, but the sector is still drawing capital. On the flip side, avoid retail exposure unless you're looking at short opportunities. The mortgage rate question is hanging over housing-related stocks, with discussions about when rates might decline to 5%, so there's uncertainty there. Capital One just launched a new business credit card, showing financial services are still innovating and competing for market share. The key is to focus on companies with pricing power and technological advantages. This is not a market where you want to be in margin-compressed, consumer-dependent businesses. Stay nimble, use tight stops, and don't chase extended moves.
Steve, let's get into the economic numbers. What's the picture looking like?
Thanks, Robert. Looking at what we've seen earlier this week, we got some mixed signals from the data. On Monday, April 13th, existing home sales came in at 3.98 million, which missed the forecast of 4.06 million and was down from the previous 4.13 million, showing continued weakness in the housing market. Then on Tuesday, April 14th, we had the Producer Price Index, and this was interesting because it came in at 0.5%, significantly below the forecast of 1.1% and matching the previous reading of 0.5%, suggesting inflation pressures at the producer level are moderating more than expected. Wednesday brought us initial jobless claims on April 16th, which showed 207,000 claims, better than the forecast of 215,000 and an improvement from the previous 218,000, indicating the labor market remains relatively tight. We also got industrial production on Wednesday, which jumped to 0.7% from the previous 1.2%. Though there wasn't a forecast available for comparison, the manufacturing sector is showing some resilience there for today. Friday, April 17th, we don't have any major economic indicators scheduled for release, so it's a quiet day on the data front as we head into the weekend.
Appreciate that overview, Steve. Now, Lizzie, let's talk about our stock of the day. We're looking at SoundHound AI, ticker SOUN. What's your take on this name?
SoundHound is a really interesting case study right now, Robert. This is a voice, AI and conversational intelligence company that's been on a wild ride. The stock is currently down 70% from its all-time high, which immediately tells you this has been a volatile, speculative play in the AI space. But here's what's notable. The stock just surged 17.6% following a partnership announcement with Associated Carrier Group, then followed that up with a 13% gain and another 6% gain in consecutive sessions. We're talking about roughly 40% gains in just a few days, which is significant momentum. The ACG deal is meaningful because it validates SoundHound's agentic AI platform for deployment across Tier 2 and Tier 3 telecom operators. This isn't just hype, it's actual commercial traction in a growing market, however, and this is critical. The technical analysis analysis shows an avoid bias with an entry score of negative 45 out of 100, which suggests the technicals are fighting against this fundamental news.
So we've got this disconnect between recent news momentum and technical signals. What should investors be thinking about with earnings coming up?
Exactly, and timing is everything here. Earnings are scheduled for May 7th, which is just 19 days away, and that's going to be the moment of truth without a P/E ratio available. We know the company isn't profitable yet, which raises questions about cash burn and the path to sustainability. The bull case is straightforward. You're 70% off the highs, you're seeing partnership wins that could accelerate revenue growth, and agentic AI is a legitimate growth market with strong demand. If management can show improving unit economics and a credible path to profitability on that earnings call, this stock could have substantial recovery potential. The bear case is equally clear. The avoid rating suggests technical resistance. This could be a short-term bounce rather than a reversal, and AI stocks have seen significant multiple compression across the board. The new sentiment is bullish at 0.467, but the overall assessment is slightly bearish with low confidence, which tells you the market itself is conflicted.
What about the competitive landscape and execution risk?
That's a key consideration. SoundHound is competing against much larger tech companies in the conversational AI space, so they need to demonstrate clear competitive advantages. The ACG partnership is a good start, but they need to convert these partnerships into meaningful revenue that shows up in the numbers. There's also been mention of short seller attention, which combined with these consecutive gains suggests we might be seeing some short covering dynamics adding fuel to the move. For year-end outlook, without specific analyst consensus data, I'd say this is highly dependent on the May 7th earnings report. If they can show strong revenue growth, improving margins and raise guidance, the stock could work its way significantly higher from these levels. If they disappoint or guidance is weak, that 70% decline could extend further. This is a high-risk, high-reward situation best suited for risk-tolerant investors with long-time horizons who believe in the agentic AI opportunity.
So the verdict is wait for earnings clarity before making any significant moves?
Absolutely, the current momentum appears driven by partnership news rather than fundamental improvement in the business model. I'd want to see the actual numbers, hear management's commentary on the competitive environment, and get clarity on the path to profitability before putting serious capital to work. If you're already in the stock, you might consider taking some profits after this 40% run and waiting to see what earnings brings. If you're looking to enter, waiting until after May 7th gives you much better information to make an informed decision. The next 19 days will determine whether this is a sustainable reversal or just a temporary bounce in a longer-term downtrend. Not appropriate for conservative investors at all. This is purely a speculative play on the AI theme with execution risk front and center.
Good analysis there. Now let's shift to crypto. Lizzie, what are the latest trends you're seeing in the digital asset space?
The crypto market is showing bullish momentum across the board. Robert Bitcoin is the star performer right now, eyeing the $90,000 level after whales absorbed 20 times the daily BTC supply over the past 30 days. That's massive institutional accumulation. We saw liquidations top $283 million after a short squeeze sent BTC above 75,000. And what's really interesting is the funding rate has stayed negative even with price above 75k, which historically suggests we might have a bottom in place. The narrative around US-Iran peace talks is triggering risk on sentiment, with some analysts targeting $125,000. However, there's short-term volatility with Bitcoin struggling to hold 76,000 and facing some resistance. On the institutional side, Charles Schwab is planning to roll out spot Bitcoin and Ether trading for retail clients, which is significant for mainstream adoption. There's also discussion around Bitcoin's quantum resistance and potential hard fork solutions, which shows the market is thinking long-term about security.
What about Ethereum and Solana? How are they positioned?
Ethereum just had its busiest quarter ever, which is notable for network activity and development. The price is approaching $2,400 with ETFs hitting a 6-day inflows streak, showing sustained institutional interest. However, there are some concerns with an Ethereum Foundation-funded program exposing 100 DPRK workers in crypto, which could bring regulatory scrutiny. We also saw key researcher Josh Stark leave the Ethereum Foundation, which is a personnel change worth watching. The sentiment is neutral to bullish, with the network growth supporting higher prices, but some headwinds from regulatory attention. Solana is looking strong with clear bullish momentum. 00 just launched high-speed data services for the Solana network, bringing Wall Street trading tech to crypto, and Tether's USDT stablecoin integrated into Plasma blockchain, which is built on Solana. That institutional infrastructure build-out is exactly what you want to see for sustained growth. The key risk for Solana remains potential network congestion, which has been an issue in the past, but the trajectory looks positive with increasing institutional adoption driving the narrative.
Thanks, Lizzie and Steve, for another informative session. That wraps up today's Morning Bell. Remember, do your own research and consult with financial advisors before making investment decisions. The markets are showing selectivity, rewarding innovation while punishing struggling business models, so stay focused on quality and risk management. If you found today's discussion valuable, please subscribe to the Morning Bell and join us Monday as we start another week of market analysis. Have a great weekend, everyone.